The introduction to understanding the real estate market in 2024 serves as a foundational framework for comparing cities as potential property investment destinations. In essence, the real estate market refers to the economic environment concerning the buying, selling, and leasing of properties, which is influenced by various factors like economic conditions, interest rates, government policies, and demographic trends. Understanding these dynamics in 2024 is crucial, as it sets the stage for making informed decisions about where to buy property, potentially determining the success or failure of such investments. The significance of this point is paramount when considering the main topic of identifying the best places to buy property in 2024. A thorough comprehension of the real estate market can provide prospective buyers with insights into market trends and emerging hotspots, enabling strategic planning and sound investments. For instance, if the 2024 market is expected to be shaped by a rise in remote work policies, cities with favorable living conditions but lower property prices could see increased demand, offering lucrative opportunities for investors. One concrete example is Austin, Texas, which has been attracting tech companies and remote workers in recent years. If this trend continues in 2024, Austin's property market may provide high return potential. Another example is Berlin, Germany, where an ongoing housing shortage combined with political reforms aimed at increasing housing supply could create unique investment opportunities in the European context. Supporting opinions often highlight the potential financial benefits of understanding market intricacies, emphasizing how awareness of trends can guide investors toward areas with appreciating property values. However, potential challenges include navigating the uncertainties of economic fluctuations, changes in interest rates, and unpredictable political climates. Moreover, some experts argue that market dynamics can sometimes be erratic and influenced by unforeseen factors, such as sudden policy changes or global crises, which can complicate predictions. Alternative viewpoints may focus on the ethical considerations of property investment, such as the impact on local housing affordability and gentrification, introducing a layer of complexity for investors to consider. Understanding the real estate market in 2024 doesn't exist in isolation. It influences and is influenced by broader societal and economic contexts. This understanding connects directly to comparing cities by providing a lens through which each city's market potential can be evaluated, thus serving as a vital tool for strategic decision-making in real estate investment. When considering the best places to buy property in 2024, one crucial factor is the local economic stability of cities. Local economic stability refers to the steadiness and resilience of a city's economy, characterized by consistent growth, job opportunities, and a favorable business climate. It includes factors like employment rates, average income, and economic diversification, which contribute to a stable housing market and can influence property appreciation over time. The significance of local economic stability in property investment cannot be overstated. A stable economy can attract new businesses, residents, and investors, which in turn can increase demand for housing and drive up property values. Conversely, cities with volatile economies may see fluctuating property values and higher risks for investors. Consequently, understanding the economic health of a city is essential for anyone looking to buy property, as it impacts both potential returns on investment and the long-term desirability of the location. Two cities exemplifying the importance of local economic stability are Austin, Texas, and Raleigh, North Carolina. Austin's economy is bolstered by a strong tech industry presence, including giants like Apple and Google setting up campuses, which fosters job creation and attracts a skilled workforce, thereby maintaining a healthy demand for housing. Similarly, Raleigh benefits from a diversified economy, with robust sectors in education, healthcare, and technology, ensuring steady economic growth and a stable property market. Several experts advocate investing in cities with stable economies as a long-term strategy. Many real estate analysts contend that economic resilience often underpins not only immediate property value growth, but also sustains it over prolonged periods, offering security against market downturns. However, local economic stability can present challenges. Rapid economic growth, while initially beneficial, might lead to potential pitfalls such as rising property prices that can outpace wage growth, creating affordability issues for residents. Critics also argue that too much reliance on a single industry, even within a stable economy, could lead to vulnerabilities, as seen previously in cities heavily dependent on now-declined industries. This focus on economic stability connects directly to other property investment considerations, such as infrastructure development and demographic trends. A thriving economy often leads to improved infrastructure and amenities, attracting more residents and boosting property desirability. Investors must also consider factors like population growth and lifestyle amenities, as they are often intertwined with and indicative of a region's economic health. Thus, evaluating local economic stability offers a comprehensive understanding of the potential risks and rewards in the property market of different cities, guiding investors to make informed decisions. When evaluating a city's property market, several criteria are pivotal in determining the best places to buy property in 2024. This concept involves analyzing various factors that influence the value, desirability, and investment potential of real estate in different urban environments. Key criteria typically include economic stability, growth potential, infrastructure development, quality of life, and market affordability. Each of these elements contributes to understanding whether a city presents a viable opportunity for property investment. The significance of evaluating a city's property market lies in its ability to guide potential investors towards sound investment decisions. As investors aim to maximize their returns and minimize risks, a nuanced understanding of these criteria becomes essential. For example, a city experiencing rapid economic growth may indicate an increasing demand for housing, leading to potential appreciation in property values. Conversely, understanding areas where market prices have peaked or face economic uncertainty can prevent poor investment choices. In practice, consider Austin, Texas, and Berlin, Germany. Austin's property market has surged due to a strong tech industry presence, vibrant cultural scene, and population growth, marking it as a hotspot for real estate investors. Meanwhile, Berlin offers affordability relative to other major European cities, alongside steady economic expansion and a high quality of life, drawing in international investors seeking stable returns. These examples underscore the necessity of evaluating market criteria to identify cities with promising real estate conditions. Opinions supporting the importance of these evaluations often emphasize the need for data-driven decision-making in real estate investment. Proponents argue that understanding macroeconomic indicators and local market trends ensures better forecasting and risk management. However, challenges arise from the unpredictable nature of economic shifts, regulatory changes, and geopolitical factors that can rapidly alter a city's property landscape. Alternative viewpoints may focus on the impact of gentrification or housing affordability crises, suggesting that chasing investment opportunities could exacerbate local inequalities. Evaluating a city's property market connects intricately to broader discussions of urban development, housing policy, and economic planning. By understanding these criteria, investors are better positioned to align their strategies with sustainable growth patterns. Additionally, this evaluation influences other aspects of property investment, including timing of purchase, property type selection, and long-term investment strategies. In summary, a thorough assessment of a city's property market is indispensable for identifying the best places to buy property, especially in a dynamically shifting global landscape. When evaluating the best cities to buy property in 2024, understanding the concept of market potential is crucial. Market potential refers to the possible growth in property value and rental income in a given location. It involves analyzing factors such as economic growth, job opportunities, population trends, infrastructure development, and governmental policies that contribute to real estate market dynamics. The significance of market potential in the context of buying property lies in its ability to guide investors toward locations with the most promising returns on investment. Identifying cities with high market potential can lead to increased property values and rental yields, ultimately maximizing both short-term and long-term financial gains. For instance, Austin, Texas, exemplifies a city with strong market potential. Known for its booming tech industry, job growth, and an influx of new residents, Austin's real estate market has consistently shown robust appreciation rates. Another example is Lisbon, Portugal, which has gained international interest due to favorable tax policies for international buyers, coupled with its vibrant cultural scene and infrastructure improvements, making it an attractive locale for property investment. Supporting opinions highlight the importance of market potential as a predictor of real estate success. Market analyst reports frequently emphasize the link between strong job markets and real estate appreciation. Additionally, developers often focus on areas where economic indicators suggest future growth, steering development projects to capitalize on anticipated demands. However, assessing market potential is not without challenges. Economic forecasts can be uncertain, and unpredictable geopolitical events or policy changes can rapidly alter a previously promising market. Moreover, gentrification controversies arise as investing in high-potential areas may lead to increased property prices and living costs, potentially displacing long-standing community residents. Therefore, some critics argue for more ethical investment strategies that also consider social impact. Understanding market potential is intricately connected with other key considerations in comparing cities for property investment. Economic stability, quality of life, and local laws are all components that not only define market potential, but are also influenced by it. For example, a city's investment in eco-friendly infrastructure can both indicate and enhance its market potential by attracting environmentally conscious investors. Thus, while market potential is a core element of deciding where to invest, it dynamically interplays with various factors that determine a city's attractiveness for property investment in 2024. Potential investors must navigate these complexities to make informed, strategic decisions.